Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Chris Verrone. Chris is a partner at Strategas and heads up the firm's macro and technical research strategy teams. Chris, how are you doing today?
I'm doing great, Ross. Great to be here.
Thrilled to have you here, and I want to start where we often do when we get a chance to talk to you, which is something that your team works on quite a bit. What is market leadership, both in the US and abroad, and what is that telling you about the economic and market outlook?
Well, I think it's a very important question, Ross, and an appropriate place to start because we use clues from the market's leadership profile to get a sense of what the market's perception of the economy is. And I think that's a big difference today compared with, say, earlier this year. So if you look at just at levels, right, S&P is back to where it was in late January, early February, somewhere in this 4,100, 4,150 range. But the difference is leadership looks more defensive and more tepid this time around. And we see that through a variety of different avenues. Something we always pay a lot of attention to is consumer discretionary versus consumer staples. Now, we equally weight that. So what is the average consumer name doing versus the more defensive part of the market? And what we've seen is discretionary really soften versus the staples over the last 5 or 6 weeks. We've seen transports weaken here as well. We've certainly seen the message from yield, which has largely been down while gold has gone up. So the message from leadership, I think, while the S&P is roughly at the same level, looks much more defensive, much more tepid, and more in context with, I would say, the market perceiving or expecting some type of a slowdown from here.
That's really great insight. And I know, in addition to looking at market composition and leadership to get a sense of what's happening in the world, another tool in your all's toolkit is historical comparison to get a better sense of what's going on in the world today. You all recently wrote a really interesting note comparing today's environment to the post-World War II, 1946 to 1950 environment. And I was wondering if you could kind of talk through that comparison a little bit for us.
Yeah, sure. One of the things myself and my partners, Jason and Don and Nick and Dan, love doing is digging into the history of this business and, finding analogs or similarities with the current environment that we think can be helpful or instructive in terms of charting the path forward. And, one period that we're particularly interested in is the immediate post-World War II period, that kind of let's call it 1946 through 1950 stretch, where you had a very volatile inflation backdrop. You had a persistently low unemployment rate. The unemployment rate was somewhere in the 3 to 3.5% neighborhood for much of that time. But you also had a consensus that was really anticipating a post-war slowdown that really didn't come until the later part of the 1940s. You had the consensus, very intent on this idea that you would get a recession post-war, and they were waiting and waiting and waiting. It finally showed up in late 48 into 49. But what's useful about that period from a market perspective is you basically were in a trading range the entire time. And I think when people in our business hear trading range, their mind immediately goes to the 1970s. That's not the only example. This 1946 to 1950 period was a vicious range. You would be up 20, then down 20, up 20, then down 20, really never making a lot of progress until you got that recession out of the way in 49. As is often the case, the market bottomed before the recession was over in mid-49, and then it was off to the races in 50 and 51. So it almost took, Ross, that recession of 49 to resync the economy and the market in the aftermath of World War II. And we think about that with respect to today, will it take a recession to resync the economy and the market, 2 or 3 years now past the COVID experience? So very useful analog, I think helpful in our thinking about what's next.
No, definitely very useful and something a bit different from the common comparisons of the 1970s stagflation or the early 2000s dot-com bubble for folks to chew on. So pivoting with our final question here, I want to get your bullish take on gold. I know you all have liked the yellow metal, and from a wealth management perspective, we might think about it a little bit differently, but make the bullish case for gold for me if you wouldn't mind.
Yeah, I think it was late September. We very sheepishly wrote the contrarian case for gold. The contrarian case for gold. that's kind of sell side talk for we like it, but we're afraid to say that we like it. But now it's worked since. We're pushing up against certainly new all-time highs. I think what's really important when you look at gold across a variety of different currencies, gold has already decisively made new highs. So gold price in yen, gold price in sterling, gold price in Aussie dollar, already at new highs. I also think very notable, this is really the only stretch I can find 6 months off a market bottom. So yesterday was the 6-month anniversary of the S&P low back in October. One of the only 6-month stretches I could find coming off a low where gold is up more than stocks. So we call it rock over paper, rock being gold, paper being stocks. Rock is outperforming paper in this environment. Very unique to see that 6 months off a low. I also think there's something to be said for thinking about gold as currency. And by our work, with US dollar down, gold is the strongest currency in the world. So I continue to like it long here. I think the trick is, when does it become too crowded, or when does it become too consensus? I don't think we're there yet. I look at flows, which, while they're up modestly over the last several months, they're just not in that very aggressive territory that we would associate with some risk. So great question. We still like it long. And that's what we think of gold.
Well, Chris, as always, this has been super insightful. I want to thank you so much for your time, and hopefully we'll get to talk to you again soon.
Look forward to it. Thanks, Ross.